When you look at a stock chart that shoots straight up, human instinct kicks in. If an asset has already climbed 200% in a single year, your brain tells you the window has closed, the money has been made, and buying now is just buying at the absolute top. Right now, Micron Technology is triggering that exact cognitive bias. The memory chip manufacturer has tripled in value since the start of the year, driven by the massive surge in artificial intelligence. But if we pull back to look at where Wall Street analysts project the stock is heading, the picture changes entirely. The consensus rating remains a strong buy, with an $1,100 target price. That implies another 54% upside. So how does an asset triple in price, yet mathematically justify moving even higher? Usually, a rally this aggressive points to a speculative bubble. To see why this one might be different, we have to look past the hype of chatbots and generative algorithms and focus entirely on the brutal, inescapable economics of physical hardware. Every advanced AI algorithm running today requires a massive physical footprint. Code cannot execute without physical architecture to store, retrieve, and move the data. And AI infrastructure operates on a completely different scale than traditional cloud computing. Processing these massive language models requires an exponentially larger volume of raw memory capacity. Comparing server types, the difference is clear. A standard server has a small memory footprint, but in an AI server, high bandwidth memory, DRAM, and NAND dominate the architecture. These servers are multiplying globally, rapidly draining the industry's available supply of advanced chips. This concentration of data-intensive workloads is creating a structural shift in hardware requirements. As AI servers become the industry standard, the amount of memory required for every unit of computing power has moved to a significantly higher baseline. Micron's latest quarterly numbers highlight a strange divergence. Revenue is surging, yet the actual number of chip shipments has only grown by a modest amount. The memory manufacturing industry is heavily constrained. Building new fabrication plants takes years, meaning suppliers simply cannot produce enough physical chips right now to meet the new AI baseline. This chart illustrates the supply squeeze. The bottom line tracks shipment volume, staying relatively flat. The top line tracks average selling price, angling sharply upward. This widening gap creates operating leverage, where profit margins expand infinitely faster than raw revenue. By controlling the supply of a constrained essential resource, Micron has transformed a commodity tech component into a high-margin luxury asset. That specific combination of fixed supply and escalating prices is exactly what is driving Wall Street's aggressive future earnings forecasts for the company. For their fiscal third quarter, analysts are projecting an earnings increase of nearly 997% compared to the previous year. This forecast shows projections accelerating further. By fiscal 2026, earnings should surge 653%, reaching $58 per share. With this massive profit expansion, Micron trading at just 13.2 times its projected forward earnings is actually statistically inexpensive, and the hardware cycle is still in its early stages. Over the next several years, artificial intelligence applications will begin migrating out of centralized cloud data centers and into everyday enterprise servers and personal computers. When you start running localized AI directly on your smartphone or laptop, those devices will require substantially more memory to function. That creates a mandatory hardware-level upgrade cycle across the entire consumer electronics sector. While major software companies spend billions fighting over who can build the smartest chatbot or the fastest generative model, the hardware suppliers don't have to pick a winner. Micron owns the physical infrastructure every single AI application has to pay for.